Hello and welcome to Earnings Echo. We put together the most important information about DoorDash Inc. Today, we are jumping right into a deep dive on their Q1 2026 earnings. The big question for you is whether this company is, a pure hyper-growth engine, or if they're just masking some messy integration struggles under these big top-line numbers. Let's look at the actual data.
Right. Well, the top line is definitely strong. I mean, Q1 revenue came in at $4.04 billion, which is an impressive 33% year-over-year jump.
Okay, that top-line pace is massive.
It is. And looking ahead to Q2, their guidance targets a gross order value, or GOV, between $32.4 and $33.4 billion. That comes alongside a projected adjusted EBITDA of $770 to $870 million.
Wait, but if you look closely at the bottom line, JAP net income actually fell 5% year over year. It landed at $184 million.
Yeah, that is the catch.
Right, so if revenue is surging that much, my immediate thought is that cash is bleeding out somewhere. What exactly is causing this immediate earnings drag and margin pressure?
So there are two main factors driving that profitability drag. First, you have a heavy hit from depreciation and amortization that is directly tied to the Deliveroo integration.
Right.
And second, they have an upcoming $50 million Dasher gas relief program slated for Q2. But, the operational volume offsetting this is really massive. Total orders actually hit 933 million.
Wow, almost a billion orders.
Exactly, which represents a 27% increase year over year.
Let's unpack that Deliveroo hit, though, because it is crucial for you as an investor to understand. I mean, DNA is essentially an accounting reality. It is a paper drag.
Right, it is a non-cash expense.
Exactly. When you acquire a massive company, you systematically write down asset values over time. It hits JAP net income hard. But it does not necessarily mean operating cash is flying out the door today. Still, I have to challenge the core strength here.
Okay.
Are their organic operations actually holding up without the Deliveroo M&A numbers?
Well, the core business is absolutely holding its own. If you strip Deliveroo entirely out of the equation, organic GOV still grew by 24% year over year.
That is still a really high baseline.
Yeah, and that organic growth is driven by record market penetration in U.S. grocery and retail. Plus, you have higher order frequency from their mature consumer cohorts. Basically, users who have been on the platform for years are just ordering more often across more categories.
Okay, so that is a solid organic base. But moving over to the earnings call, management's tone about their tech spending really caught my attention. They are allocating serious capital right now to run 3 different tech platforms simultaneously.
Yeah, the redundant costs.
Right. It is a massive temporary cash burn, like paying rent on 3 different houses while you take your time moving furniture into just one.
Management did not seem to be sweating it on the call, though. I mean, they openly acknowledged those redundant costs during this transition phase. But their explicit guidance is that these redundancies will phase out entirely by early 2027.
Early 2027.
Exactly. They plan to consolidate everything onto a single global platform by then.
Okay, so they have a clear plan to clean up the tech stack, but the real question for you is whether the market has already priced in that perfect execution. I want to look at the reverse DCF to see what expectations are baked into the stock right now.
Sure. So just to define that briefly, a reverse DCF flips the traditional math. Instead of guessing what the company will be worth in 10 years, we look at today's stock price and ask what kind of growth the market is already assuming as a given.
Right.
So at a $74.7 billion market cap, using a 9.5% cost of equity and a 3% terminal growth rate, the market implies a massive 24.67% 10-year net income compound annual growth rate.
Wow. That is what we call priced for perfection. I mean, to hit nearly 25% net income growth year after year, DoorDash needs to aggressively expand margins, not just maintain them.
Definitely.
They have to successfully scale their higher margin advertising business to over $3 billion and totally finalize those delivery synergies.
Yes, but looking at another metric, their forward enterprise value to EBITDA multiple sits at roughly 23.5 times. And, EV to EBITDA strips out debt and taxes to compare total value against core cash earnings.
Okay.
So 23.5 times, it actually presents a much more moderate picture compared to that really steep net income hurdle.
Fair point. So to summarize the key echo for you, DoorDash is priced for flawless execution. They are transitioning from hypergrowth to hyper-efficiency, and they have to meet that roughly 25% annual net income growth hurdle.
And a final analytical prompt for you to monitor? Watch closely to see if management successfully offsets those Q2 gas relief costs. That is going to be the true test of whether they can actually deliver their promised second-half EBITDA margin expansion.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.